What does it actually feel like to become an investor? You've heard the promise, $500 a month at 22 and you're a millionaire at 60. Index funds beat hedge funds. Time in the market beats timing the market. You know the phrases. Almost everyone under 35 knows the phrases. What nobody tells you is what the journey between $100 and $10 million actually feels like on the inside. Because the phrases are correct, and also nearly useless without the pattern of feelings that come with them. The numbers at scale. 58% of Americans own stock in some form, mostly through 401ks. Only 21% hold individual stocks outside retirement. The median retail brokerage account has $9,500 in it. Over the last 10 years, U.S. mutual funds and ETFs delivered 7.3% annually. But the average investor earned 6.3%. That's a 1.1% gap every year because people panic sold into the 2020 crash and chased back in at the 2021 top. The market was not the problem. The investor was. 7 levels. You start at 19 with $100 and a phone. If you make it all the way, you are 55 with an 8-figure portfolio, and you mostly don't look at it anymore. In between are 12 specific moments that most people never describe, because most people either quit during them or stop being honest about them. Here's what it looks like. Level 1. The first $100. You are 19 years old. You are sitting on your dorm bed at 11:43 p.m. on a Tuesday in October. You just finished setting up a Robinhood account. Your debit card information is in, your bank is connected. You have $240 in checking, and you have just transferred $100 of it into a new account that, 5 minutes ago, did not exist. You buy 3 shares of a company you used a product of once. The purchase takes 4 seconds. A confirmation bubble says you now own something. You don't feel like you own anything. It looks the same as it did 30 seconds ago because there is nothing physical to own. Stock ownership is the most abstract form of wealth that has ever existed in human history, and your first encounter with it is on a phone at night while your roommate plays video games 4 feet away. You check the app 11 times in the next 2 hours. Up 43 cents, down 19 cents, up $1. You refresh like you're waiting for a text from someone you just met. This is a pattern your brain is going to repeat for years. It is called variable reward learning. And it is the same mechanism slot machines use. Robinhood knows this. That's why the app makes a confetti animation when you buy. The app is not neutral. The app is training you. Here's what nobody tells you about starting with $100. The dollars don't matter. What matters is that you started. Compound interest does nothing in the first 3 years. You put in $200 a month for 3 years, and at the end, you have $7,200 plus a few $100s of growth, which looks like a rounding error on a chart. Most people quit here. They quit because the chart is flat and the feeling of progress is absent, and they interpret the absence of motion as failure. It is not failure. It is the part where the pattern has not compounded yet. The compounding is invisible by design. Your friend Danny doesn't have a Robinhood account. Danny is your best friend from high school. He went to the community college near home and got an associate's degree in facilities management. He is now 20 and works for the county parks department at $23 an hour, plus full benefits, plus a pension that vests at 10 years. Danny thinks the stock market is a casino. He says so out loud at a Thanksgiving dinner, and your father agrees with him, and you say nothing because you are 19 and you don't have the vocabulary yet to explain the difference between timing the market and being in the market. You won't have that vocabulary for another 4 years. Level 2. The first crash. You are 21 now. Your portfolio is up to $4,000. You put in $200 a month plus $600 from a summer internship, plus a $400 birthday check from a grandparent you barely know. You are tracking the gain every day. You are not the same person you were 2 years ago. You have opinions now. You know what a PE ratio is, sort of. You subscribe to 2 newsletters and you listen to a podcast on your walk to class. In 6 weeks, your $4,000 becomes $2,100. The specific mechanism, You put 40% of your portfolio into a single tech stock after reading a Twitter thread that promised it was about to break out. It did not break out. It was in the middle of a larger sector rotation that you did not understand because nobody had written the thread about the rotation yet. The thread that warned about it would be written a month after you sold. You sell at a 48% loss at 2:47 a.m. on a Wednesday. You sell because you cannot take looking at the red number one more day. The red number has become a thing that follows you into class. You cannot concentrate. You check the phone under the desk. You check it in the bathroom. You check it before you fall asleep, and the first thing you check when you wake up. Selling, finally, at a loss, produces a specific kind of relief that you have never felt before. It is the relief of ending a pain, which is different from the relief of winning. Nobody warns you that these two feelings are different. You will confuse them for years. The second thing nobody tells you about investing. The first crash is not a setback. It is the tuition. You just paid $1,900 to learn that your conviction in a stock you researched for 3 hours is worth less than the conviction of a market you do not control. Some investors learn this lesson at 21 for $1,900. Some learn it at 35 for $190,000. The lesson is the same. The price is different. Danny hears about it. You tell him at a bar over a cheap beer because you can't tell anyone else. He doesn't gloat. He says, "That's rough, man." And then he changes the subject. And this is the specific gift of friendships that are not about money. The gift is that not everything has to be a referendum on your choices. Danny is not tracking your portfolio. Danny is building a life that does not require a portfolio. You stay out of the market for 4 months. Then you come back. You come back because the only thing worse than the memory of losing is the idea of missing what happens next. Level 3. The Index Convert. You are 24. You have just read a book your father owned and never recommended to you, which is the strange truth about a lot of what fathers own. The book is about index funds. It says, in so many words, that you are an idiot. It says that 85% of actively managed mutual funds underperform the S&P 500 over any 20-year period. It says that the best thing you can do with money is buy a low-cost, total market index fund and never sell it. It says this in a voice that sounds like somebody who has seen you lose $1,900 at 21 and is trying not to say so directly. You close your individual stock positions, all of them. You transfer $12,400 from Robinhood to a Vanguard account. You set up automatic monthly contributions of $400. You turn off the Robinhood notifications. You delete the app from your phone. You reinstall it 6 weeks later. You delete it again. You reinstall it. You finally delete it for good in the second week of that winter at 3 a.m. after checking it one last time out of habit. This is called capitulation in the reverse direction. You have surrendered to the boring answer. The boring answer is not boring because it is dull. The boring answer is boring because it removes the dopamine. And you have spent 5 years training your brain to need the dopamine. Quitting individual stocks feels like quitting a substance. There is a withdrawal period. Most of the people you know on Twitter do not survive this withdrawal. They go back to options in 6 months because the variable reward pattern is stronger than the math. Here is the scale beat. Over the past 20 years, the S&P 500 has returned an average of 9.8% annualized, including dividends, or about 7.5% after inflation. A $10,000 investment left alone for 40 years at 7.5% real return becomes $184,000 in inflation-adjusted dollars. The same $10,000 actively traded by the average retail investor, based on Morningstar's Mind the Gap study, would have returned about $137,000. The cost of being an active investor over 40 years is roughly $47,000 for every $10,000 you put in. Most people do not calculate this number. You are now, at 24, one of the people who has. The third insider truth. The best investors in the world are not the smartest. They are the ones who can do nothing. There is a psychological profile that correlates with long-term investing success, and it is closer to the profile of a monk than the profile of a trader. patience, low reactivity, a willingness to be wrong for long periods, and a specific kind of boredom tolerance most young men do not have. You don't have it yet either. You are training it. Danny buys a house that year, $240,000 in a suburb that your college friends consider unfashionable. He puts 5% down on an FHA loan. His mortgage is $1,640 a month. Your rent in the city is $1,920. Danny, who does not invest in stocks, now has more of his money going into an asset that will grow than you do. You notice this. You do not say anything to him. You do not need to. The math is doing the saying. Level 4. Real money. You are 29. Your combined portfolio, brokerage plus Roth IRA plus 401k, hits $100,000 on a Thursday in March. You take a screenshot. You do not share it with anyone. Screenshots of six figures in a brokerage account are a specific form of pornography that you have come to understand by now, both the appeal of taking them and the shame of sharing them. You save it to a folder labeled Life that you will never look at again. The fourth insider truth. $100,000 is the hardest milestone. Charlie Munger said it. He said the first $100,000 is a bitch, and that after that, you can ease off the gas a little. He was right. From $0 to $100,000, your contributions do most of the work. From $100,000 to $1 million, the market does most of the work. You have crossed a threshold most people never cross. Roughly 54% of American households have $0 in retirement savings. Another 20% have under $50,000. You are, at 29, in the top quintile of your country by this one measure alone. You do not feel rich. That's the strange part. $100,000 looks like a screenshot and nothing else changes. Your rent is still your rent. You still pack lunch 4 days a week. You still hesitate on a $120 haircut. The wealth is real, but the life has not yet caught up to the wealth. And for some people, it never will. And those people are the ones who end up with $4 million at 60 and still wear the same jacket they bought at Costco in 2019. These people are the investors who win. This is the year something quieter starts to happen. You stop checking your portfolio daily. You check it maybe twice a month. The check itself stops producing anything. You've trained the dopamine out, or more accurately, the dopamine has trained itself out, because the portfolio no longer moves in chunks you can feel. A 1% day now moves $1,000, which is more than your entire first portfolio was worth at 21, and you feel nothing. You have internalized scale. This is both a superpower and a small grief. Some of them will tell you the grief is not real, that you should just be grateful. They are partially right. You are grateful. You are also, for the first time in a decade, aware of how your relationship with money has changed you. The version of you at 19 who felt a buzz at a 43-cent gain is gone. He is not coming back. You don't fully miss him, but you notice that he is gone, and the noticing is its own small event. Danny's house is now worth $340,000. He has built $100,000 of equity over 5 years, mostly because housing prices in his area went up, which is a form of wealth building he did not design but is collecting anyway. Danny and you now have approximately the same net worth. He achieved it without ever looking at a chart. You achieved it by looking at a chart nearly every day for a decade. This comparison does not make you wrong, and it does not make him wrong. It is just a fact worth naming out loud, because most of the internet is pretending this fact does not exist. Level 5. The accredited investor. You are 35. Your household income crosses $200,000 for the second year in a row. Or your liquid net worth crosses $1 million excluding your primary residence, or both. Under SEC Rule 501A, you are now an accredited investor. This is a legal designation that grants you access to a door most Americans cannot walk through. About 13% of U.S. households qualify. The other 87% are structurally barred from the asset classes you are about to learn about. The door leads to private markets. Venture capital funds with $25,000 minimums, private equity with $100,000 minimums, hedge funds with $250,000 minimums, real estate syndications, private credit, structured notes, direct angel deals into companies that will either 100x or go to zero in 4 years. The door, once open, stays open. You will receive emails for the rest of your life from funds you have never heard of, all of which will assume you know how to read a term sheet. The fifth insider truth: becoming accredited does not mean you should use the access. A surprising portion of accredited investors underperform the S&P 500 over their lifetimes, specifically because accreditation convinces them they are sophisticated enough to stock pick again, which is the exact mistake they stopped making at 24. The index fund does not care if you are accredited. The index fund returns 7.5% whether you are wealthy or not. For most people, the door should be admired and then not walked through. You walk through anyway. Of course you do. Most of us do. You put $50,000 into a pre-seed venture fund. You put $25,000 into a real estate syndicate in Austin. You put $100,000 into a private credit fund that pays 11% annually. You do all of this in a single 18-month period because you have finally earned access, and access, once earned, is almost impossible not to use. 2 of these 3 investments will go to zero. The third will pay you 11% for 3 years and then close to new redemptions during a credit cycle you did not see coming. You will net, across all 3, roughly negative $30,000 over 5 years. During the same 5 years, if you had left that $175,000 in a total market index fund, it would have become about $250,000. The cost of your accreditation, measured correctly, was $105,000. You will not calculate this number until you are 42. Most accredited investors never calculate it. Danny is now 36. He has 2 kids. He has paid off half his mortgage. He has $180,000 in a 457 plan because his county offers the nonprofit equivalent of a 401k, and he has been contributing 12% of his paycheck since he was 22. He is not rich. He is not worried either. He has the kind of net worth that does not appear on anyone's list and does not need to. Level 6, the 7-figure portfolio. You are 42. Your liquid portfolio is $3.2 million. Add equity in a home, and it's closer to $4.1 million. You have beaten the S&P over your lifetime by about 0.4% annually, which sounds small and is actually massive. It is the difference, over 20 years, between $3.2 million and $2.8 million. Most of that outperformance came from 2 specific years when you did nothing, which is the most annoying and true fact about investing. At this level, the strategy changes. You are no longer accumulating. You are preserving. The psychology flips. For 20 years, you wanted the market to go up, because contributions plus rising prices compounded faster. Now you want the market to go up, but not too fast, because every dollar of paper gain above your withdrawal rate is a dollar the taxman will eventually claim. You have started thinking about tax optimization, which is the sign that you have entered a new country. The taxman is the final boss, and nobody told you he existed until you got here. Here is the scale beat for level 6. With $3.2 million invested at a 4% safe withdrawal rate, you can spend $128,000 a year indefinitely without running out. At a 3.5% rate, more conservative, you can spend $112,000 a year. The math of financial independence says that at 25 times your annual expenses, you are done. You have 25.6 times $125,000. You are, by the strictest definition, free to stop working. You do not stop working. You work for 6 more years. Some people at this level work another 20. The work is not about the money anymore. It is about the structure, the identity, the calendar. Most millionaires are still working at 50, not because they need the money, but because the alternative is a silence they have never learned how to occupy. You start to talk about money differently. Not with friends from college, Not with Danny, who now makes $94,000 a year plus benefits and has, on paper, about $610,000 net worth, including his house and pension. You talk about money with a specific kind of stranger who also crossed $3 million, because they are the only ones who know what you are actually asking. These strangers become a second social layer that runs parallel to your real one. You meet them at conferences, in weird board seats, at birthday parties in neighborhoods you did not grow up in. This is the quiet social stratification of wealth, and it does not feel sinister until you realize how clean the split is. Some of them will tell you this second social layer is where the real friendships are. Some of them will tell you it is a sealed compartment that has replaced what used to be honest. Both camps are right, probably, and which one you end up in has almost nothing to do with how smart you are with money, and almost everything to do with how honest you are able to be about what the money has taken from you. Level 7. The exit. You are 55. Your portfolio is somewhere between $8 million and $14 million, depending on the year. You have stopped tracking it daily. You have stopped tracking it monthly. You check quarterly, which is the same rhythm your grandfather used to check his pension statement, and this is one of the things you did not expect to find yourself doing. The irony of Level 7 is that it looks exactly like Level 3. You are back in a broad index fund because most of the complexity you bought in the middle levels turned out to be subtracting value. The private equity funds underperformed. The real estate syndicates had good years and bad years and netted out to roughly the public REIT index. The hedge fund allocation returned 4% in a decade when the S&P 500 returned 11%. Your portfolio today is maybe 80% index funds, 15% bonds, 5% cash. A competent 24-year-old could construct it in 20 minutes on a Sunday night. The sixth insider truth. By the time you know enough to invest actively, you are rich enough not to need to. This is the final joke of the asset management industry. The people it serves the least are the people who need its services the most. The people who need its services the least, the wealthy, the sophisticated, the accredited, are the ones who pay the highest fees for the smallest marginal returns. Danny retires at 62. He gets his full county pension, which pays $5,400 a month for the rest of his life, indexed to inflation. He owns his house outright. He has $400,000 in his 457 plan. His net worth is somewhere around $900,000, not counting the pension, which if you capitalize it at market rates is worth about another $1.1 million. So Danny is, functionally, a $2 million retiree. He never once opened a brokerage account. He never once read a book about investing. He followed a script written for him by his union and his employer and the FHA loan program, and the script worked. You meet Danny for coffee a few months after he retires. He asks how you're doing. You say you're good. He says, "Still doing the stock thing?" You say yes. He nods. You both drink your coffee. He doesn't ask what the portfolio is worth. He never has. You think about how many of the specific moments of your life were spent watching a chart move. How many hours across 36 years? You try to add them up. You stop, because the number is going to be depressing, and also because the number is not the point. The point is that you did the thing, and it worked, and you are here now. And being here now is enough, even if the path you took was not the only path, and not even necessarily the right one for every person who will try it after you. The ladder you climbed was never the one you thought you were on.